That shouldn't even be legal. So in 3 years, you not only owe the 181,000, but the 287,000 on top of that because of
Yes.
a home equity investment or a shared equity loan. Jenn
Okay.
Carver is my badass loan partner, and she is such a terrific counterpart because she does the math, and math doesn't lie. And she's way more OCD than I am, which is great. That means that our loans fly through, and our clients have great experiences, typically closing loans as quickly as 2 weeks to 21 days.
Mm.
So today we're just talking about the home equity investment loan. I have warned people about this. I want to show you the Federal Consumer Financial Protection Board has a whole warning on this. It talks about what these options are and how they work. And it's the warning. Home equity contracts are expensive compared to other home secured financing option. The settlement amount grows at a rate of 19 to 22%, which is shocking. And they talk about this down here, forgive that, the Blair Witch scroll. But if you look at that, this is an example where a homeowner took out just 50,000 and assuming an appreciation rate of 6% per year, as soon as 10 years, you could owe in a market, particularly in California, where our homes appreciate quite a bit, especially if you're doing home improvement, they would have to pay back 215,000. And this is a classic year three. By year three, you could pay up to 179,000, which is by year three. That's insane. And in this scenario, the cost of the home equity contract is 20% per year for the first 5 years. That is like a shocking amount because it's not the interest rate, it's taking the value of your home. So you just saw that. Like, what did that
Yes.
look like in practice?
Well, okay, so the clients they had borrowed, they wanted $181,000. So what this company did was is that they evaluated the company. They when they had the appraisal done, when they were first taking out the loan for 181,000, the appraisal came in at $910,000. That's how much the property was worth. However, what they do is they give themselves a 20% cushion. So they devalued the home down by 20%, and the home's value
What?
was 700. So they devalued it down to 700. They reduced the value down to $728,000. So right there they've already made a 20% profit on what the house actually is worth. So
That's
then
like
so then
$180,000 basically just for
just
the
right off the
right to
bat.
do the deal. Oh my
Yep,
gosh.
right off the bat. And so then they've done improvements, and this has been now they've had the loan for 3 years. They've had it for 3 years, going on 4 years. And now their payoff is $467,745, which is a difference of, let's see,
What?
467, 745. Yeah, 181 minus. So that's a difference of $286,000, 286,745 in a matter of not even 3 years. What by
Oh my
36 months?
gosh. So
Yeah, so
that
that's
loan could take over the entire equity of their house.
yeah, because the house is the improved value now is at 1.349. So what they do is that they start with whatever the value was right when you took out the loan, which in this case it was 728,000. And now the value of it is 1.349, and they take 50% of that. The contract is for 50%. So whatever the difference is between the value, they take 50% of that, which now that's how we get to 467,000, which is a gain for them of $7,965 a month for that company is making on these clients per month at this
That
point.
is
Crazy.
That is insane. Why? I'm
Crazy.
not even sure that shouldn't even be legal, but certainly nobody should take that. So in 3 years, you had a loan for 181,000. So in 3 years, you not only owe the 181,000, but the 287,000 on top of that because of
Yes.
a home equity investment or a shared equity loan.
Yep. Hmm. And you're not allowed to, you cannot refinance the house or take a cash out until they're paid off first. So they get their money regardless.
Right. And I understand you can't just pay them over time. You have to pay them in a lump sum.
True. Yes.
Can we qualify that client to get rid of this group because the debt's too high?
Because they have too much debt along with this $467,000, we can't qualify them. No.
See, that's what bothers me so much is people go into the construction thinking that, oh, I'll just take this loan and then I'll figure it out later. Well, a lot of times we can't figure it out later. And the HEI programs, the home equity investment programs or shared equity is one of those classic traps in construction.
Yeah. Especially when they give themselves a 20% buffer right off the top. Right off the top, that's what they've made. So
That is
yeah, so
shocking.
910,000. So 910,000 and they valued it at 728. So they gave themselves a $182,000 buffer right off the bat.
That is just shocking. Um,
Crazy.
So lesson learned is number one, stay away from the home equity investment or shared equity traps that these companies are offered. By the way, they're offering that because they claim you have no payment. Well, yeah, they have no payment because they're taking the equity of your house.
Half of it, they're taking half of it.
Yeah,
Half. At
yeah.
49, the contracts were 49.955% of the equity from the time that they devalued the house till the current equity. And yeah, it's gone up substantially. And so now they owe almost $500,000 and we can't, and they won't go in third lien position. They won't subordinate to a third lien position for homeowners to get a cash out like a second mortgage, a HELOC or so forth. And so they won't even go into third lien positions. So they want their money. So the people are they're just stuck.
Wow. That is
Mhm.
terribly, terribly shocking. And so as my loan partner, you see a lot of people who've done these crazy loans. You've even seen how many clients have we had that paid for an ADU with credit cards? Yeah. And what
Uh,
happens? What do you see happening with that?
well, because their debt becomes so high and we can't get them qualified because there's not enough income coming in from them in order to qualify. Their debt to income ratios are too high. So it's just by paying for these with credit cards, not a good idea. Taking out a home equity investment loan, not a good idea.
So, but if they start with a 0% credit card, how could the DTI be too high?
Those are teaser rates. Those are teaser rates. The 0% is not for the life of how long you have the card. It's for 12 months. So then everything you put on there after 12 months, now you've accumulated a whole bunch of debt unless it's paid off. And where are you going to get the funds to pay it off? You're not going to get it until you refinance the house. So it's like a catch 22. You're constantly chasing your tail. So it's not a good option at all.
That's awesome. Thanks,
Yeah.
Jen. Jenn
Okay.
Carver is my badass loan partner. And she is such a terrific counterpart because she does the math and math doesn't lie. And she's way more OCD than I am, which is great. That means that our loans fly through and our clients have great experiences, typically closing loans as quickly as 2 weeks to 21 days. Jenn
Okay.
Carver is my badass loan partner. And she is such a terrific counterpart because she does the math and math doesn't lie. And she's way more OCD than I am, which is great. That means that our loans fly through and our clients have great experiences, typically closing loans as quickly as 2 weeks to 21 days. So, yeah, thanks, Jenn, for joining us today. I appreciate it. That warning is so important because honestly, you don't want a bad news call from Jenn.
Well, true. So everybody stay away from the home equity investments. It's not, the HEI loans are not a good way to go by
Yeah,
any means.
or the 0% credit cards.
Or the
Cool.
0%. Yeah, exactly.
Yeah, and you're going to have fun with another client coming in. We did a HELOC, paying off 170,000 of debt. They did paid that off, and then they promptly turned around and took a no payment hard loan for 400,000 to build a 2-bedroom ADU that will rent for maybe 3,000. And I'm like, how are you going to refinance
Yeah,
that?
how are we going to do that? Right.
And guess what? They ran their credit cards back up again. I'm not even going to send that one to you, Jen. I'm just
Oh,
yeah,
no.
you're not, don't even apply. I know. It's terrible to
Yeah.
say, but we can't work harder on your lives than you do. And it's the cheap way out, the easy way out. And that comes sometimes with hard lessons. It's
Yeah.
unfortunate, but true.
Yeah, they really need to have a structured plan and out. They need to have figured out how they're going to get out of this debt once they've gotten into it to build
Hmm.
these, and they really need to weigh all their options. And those two are not one of them by any
Yeah,
means.
awesome.
Okay.
That's all we have for today. Thank you guys
Thank
so
you.
much, and we'll catch you at Tiny Fest this weekend. Have a good one.
Thank you. Okay. Okay, bye.